stop scrolling. Because what I'm about to tell you isn't theory, it isn't hype, and it isn't another nerdy financial phrase that belongs in a dusty economics textbook. No. What's unfolding right now is the financial equivalent of standing on a beach while the ocean silently disappears into the horizon. People smile, the sky is calm, the air feels normal. But everyone who understands what that means is already sprinting for high ground. The signal I'm talking about has never, not once, been wrong in half a century. Not during stagflation in the 70s, not during the dot-com insanity, not during the housing bubble, not even during the chaos leading into the Great Depression's modern twin in 2008. And right now, it's not blinking, it's not whispering, it's screaming. Yet most people shrug because they hear the phrase yield curve inversion, and their brain checks out like someone asked them to do calculus at midnight. They assume it's irrelevant, something for bankers in expensive suits and Wall Street interns overdosing on caffeine. But here's the truth. No one tells the public. When the yield curve flips upside down, it's the closest thing the economy has to a doomsday siren. Because under normal conditions, lending money long-term pays more than lending short-term. That's common sense. If you give the government your money for 10, 20, or 30 years, you expect a higher return than if you lend it for just a few months. But when short-term rates shoot above long-term rates, that's not normal. That's not random. That's a sign of fear. Deep institutional level fear. It means investors are so nervous about the near future that they're willing to take less profit just to park their money somewhere safe and untouched for years. That isn't strategy. That's survival instinct. And every single time in modern history that instinct hits critical mass, an economic collapse follows within about 12 to 18 months. Not occasionally, not sometimes, every single time. Let's rewind. In the roaring 1920s, people thought the good times would roll forever. Millionaires were minted overnight. Regular Americans borrowed money just to gamble in stocks, convinced nothing could go wrong. The Fed tightened rates, speculation was burning like wildfire, and the yield curve inverted. 18 months later, October 29th, 1929, Black Tuesday. But here's the twist history class never mentions. It wasn't just a stock crash. The entire financial system was a fragile spiderweb. Brokers borrowing from banks, banks lending against inflated assets, everyday citizens gambling with money they didn't have. When one thread snapped, the whole web collapsed. Fast forward nearly 80 years. In 2006, the same pattern emerged. The yield curve inverted again. Housing prices skyrocketed. Anyone with a pulse could get a mortgage. Banks turned loans into exotic securities, selling them like candy. Wall Street partied as if the rules of risk had been deleted from reality. Once again, almost nobody paid attention. And then, the housing market stopped rising. Suddenly, those mortgages weren't assets. They were landmines. Banks holding mortgage-backed securities used them as collateral for more loans, which were packaged into even more exotic products, which were sold to institutions managing pension funds, retirements, insurance policies, everything. When one piece failed, the entire financial machine imploded. Lehman Brothers vanished. Bear Stearns collapsed. Trillions evaporated like smoke. History didn't repeat itself. It escalated. And today, the same warning signal is more inverted, more distorted, and more violently out of alignment than in both of those historic collapses. But the difference now is chilling. The global financial system isn't just interconnected, it's fused, which means next time, when the chain snaps, it won't break quietly. It will break everywhere, all at once. And whether someone understands or ignores the warning won't change the outcome, but it will determine who gets crushed by it and who walks away owning everything left standing. Brace yourself. Because the financial storm that's building now makes 1929 look like a lemonade stand, and 2008 like a playground scuffle. We are watching the same terrifying script play out for a third time, but this edition is on steroids. Technology, global interconnectivity, and monetary policies that would have been science fiction in past eras have rewritten the rules of the game. The yield curve inverted in 2022, and the forces lurking beneath today's economy make the last two crashes look almost quaint. Let's talk scale. In 1929, total U.S. debt was serious but digestible. By 2008, it had ballooned but still within historical limits. Today, debt has exploded into a monster of such size and scope that ordinary people can't even fathom it. Government debt, corporate debt, student loans, credit cards, mortgages. The numbers are astronomical, abstract, almost surreal. But size alone isn't the danger. It's speed and interconnectivity. In 1929, a bank failing in New York might ripple across the country over days or weeks. In 2008, electronic trading shrank that timeline to hours. Today, with algorithmic trading, cryptocurrencies, and derivatives living entirely as computer code, financial hurricanes can race around the globe in milliseconds, destroying whatever stands in their path. And don't even get me started on the aftermath of the last crisis. After 2008, the Fed didn't fix anything. They printed trillions and kept rates near zero for a decade. That wasn't salvation. It was a time-delaying tactic, inflating asset prices and feeding a global borrowing addiction. Debt wasn't solved. It was compounded. The cheap money era birthed bubbles no one even recognizes as bubbles. Real estate prices in major cities detached from reality. Stock markets soared to levels that would have been laughed at decades ago. Corporations borrowed to buy back their own stock instead of building real value. The economy became addicted to easy credit. And now that addiction is under a stress test more brutal than any before. This isn't your grandfather's yield curve inversion. The battlefield has expanded. We're no longer just speculating on stocks or housing. We're speculating on everything. Crypto markets, unthinkable in 2008, now represent trillions in paper value, propped up by nothing more than collective faith. Private equity firms have gobbled up hospitals, newspapers, and entire sectors on borrowed money, creating weaknesses where stability once reigned. Meanwhile, the central banks, their ammunition is spent. Interest rates were already near zero when the pandemic struck, forcing them to print even more, and in some countries, push rates negative. Government spending exploded to levels that would have been politically impossible just a few years ago. The tools that fixed previous crises have been exhausted, and the enemy approaching is unprecedented. Here's the cruel twist. Most people think the system worked. They believe the Fed saved the economy in 2008 and again in 2020. Wrong. Those were delays, not victories. Each intervention piled weakness on top of weakness, creating new vulnerabilities that didn't exist before. The yield curve inversion today isn't just a warning of recession. It's the countdown to a moment when the entire financial system's band-aids, lifelines, and magic tricks fail simultaneously. And the scariest part? Nobody knows exactly how the crash will unfold. Every previous crisis had a playbook. Lower rates, boost spending, print money, confidence returns. All patched up. Until next time. But today, the old rules are gone. Interest rates have been distorted for so long they no longer reflect reality. The price of money, which should follow supply and demand, has been weaponized as a political tool. Central banks believe they can engineer prosperity by making debt cheap and savings worthless. The result? An economy on life support, addicted to artificial stimuli, unable to survive without constant intervention. And the yield curve is screaming that the machines keeping it alive are about to fail. Permanently. Because what I'm about to paint isn't theory. It's reality. Raw, unfiltered, and unavoidable. Think about you, your family, your life, your savings account. Practically worthless because central banks decided rewarding discipline was less important than pushing debt down everyone's throat. Your home? Costs 3 times what it should because cheap money turned shelter into a leveraged investment machine. Your job? Propped up by companies that thrived on borrowing at near zero rates, funding operations that would collapse under normal circumstances. The system is sick, and the yield curve is screaming that it can't sustain this. But here's the kicker. Unlike previous inversions, the escape routes that once existed are gone. Rates can't fall. They're already hovering at zero. Governments can't spend without exploding debt. The playbook that patched the economy in 1929 and 2008, fully exhausted. Corporate America, addicted. For 15 years, cheap credit rewired the game. Research and development, replaced by share buybacks. Genuine innovation, replaced by financial engineering. Companies borrowed, not to grow, but to inflate stock prices and pad executive bonuses. When that credit dries up, they won't just wobble, they'll forget how to function as real businesses. And the connections? They've mutated. In 1929, banks were linked through simple lending relationships. In 2008, through mortgage securities most couldn't decode. Today, they're intertwined through derivatives, cryptocurrency exchanges, foreign currency swaps, and ultra-fast algorithmic trading, networks that move faster than any human can follow. A single collapse in the system doesn't stay local. It cascades, hitting pension funds, banks, tech stocks, and institutions you didn't even know existed. Add the global layer. The dollar is the world's reserve currency. When the Fed prints or hikes rates, it doesn't just ripple through America. It shakes the entire planet. Countries with dollar-denominated debt could implode. Trade relationships shatter. Supply chains delivering food, medicine, and electronics fracture. Chaos isn't coming. It's pre-programmed. But the psychological trap is deadlier than the financial one. Past generations knew markets rise and fall. Crashes were part of the natural rhythm. Today's investors, they've been trained to expect central banks to save them. Moral hazard reigns. Pension funds chase junk bonds. Retirees chase growth stocks. College grads rack up six-figure debts for degrees with no prospects. When the system breaks, it won't just destroy wealth, it will obliterate faith. The social contract. Work hard, save, trust the system. Revealed as fiction. And the fallout? Political consequences that could eclipse the economic ones. This moment is worse than 1929 or 2008 because it's the culmination of all past mistakes, turbocharged by technologies and policies that removed the natural limits on excess. The yield curve inversion isn't predicting a simple recession. It's predicting the collision of decades of financial engineering with unvarnished economic reality. And here's the existential question. Will the institutions and relationships holding society together survive the impact? History suggests they might not. If they fail, the financial collapse will be the least of our worries. The warning signs aren't hidden. They're blazing neon lights in a thunderstorm. Corporate earnings rigged with accounting tricks that would make Enron blush. Banks reporting record profits while quietly reserving billions for losses they expect. Government statistics that measure everything except what families need to survive. Look at the labor market. Healthy unemployment masks millions who've stopped looking for work. The new jobs? Pay too little to live where the work exists. Housing versus food, transport versus healthcare, today's survival versus tomorrow's security. The gig economy celebrated as freedom? It's desperation in a marketing wrapper. No safety net, no predictable income, one missed payment from disaster, one emergency from bankruptcy. The yield curve doesn't lie. It's screaming that everything we've been told about stability and recovery is illusion. This isn't fear-mongering. This isn't prophecy. It's math. It's history. It's human nature converging into an inevitable collision. The only remaining question is, will you be one of the millions caught unprepared when the illusions shatter? Or one of the few who saw it coming, positioned to survive and thrive when the dust settles? History has already given you the blueprint. The signs are everywhere. The choice? It's yours.